All right, in this video, you are going to see how a retirement plan is constructed and what some of the considerations are when you retire. If you are getting ready to retire, then you know that there are a lot of different decisions that have to be considered so that you feel secure in your retirement. And many people are overwhelmed with their healthcare coverage, with their income, whether they file for Social Security and when. How do they move over their 401k into an IRA? And if you're selling a home, that adds another layer of complexity to it. And if you need to update your estate plan, then you're just swimming in confusion. And so in this video, you're going to learn how a firm can put together, a professional registered investment advisor can put together a retirement plan for you to help you to navigate some of these decisions. And I'm sharing this because I just had a meeting last night with a client who's going through this, and there are a lot of different considerations that we discussed. And I think it's valuable for people to understand what is involved with a retirement plan and why would I pay a professional to go and create a retirement plan for me when I have so many free tools at my disposal that I can just use myself and not have to pay thousands of dollars in fees. So I want to start by just giving you an overview of the situation that she had. So she is 68 years old. She's retiring from a defense contractor here in the state of Maryland, and she's going to be selling her home and moving into a home that she purchased in Pennsylvania. And she is retiring on December 12th, so roughly 2 weeks from today. And what she's going to have to decide is, how does she continue her medical coverage? That's one of the primary concerns because she won't have her Medicare when she retires. She just filed for her Medicare, so she's going to need to continue her existing insurance policy from her work. And you can do this by using something called COBRA. COBRA is going to allow you to keep your existing coverage at work. You become responsible for 100% of the premiums plus surcharge there. But in her case, she's only going to have to cover those premiums for a few months, likely until February when her Medicare coverage kicks in. But she is going from having that full plan at her employer to now relying on Medicare. And she does have TRICARE, but we still want to give her the option for a Medicare supplemental plan, just in case that she needs some additional coverage for medications that she's taking. She recovered from cancer last year, so she's on additional medication here that we would want to consider having some coverage for. And so I referred her to a specialist if she wants some help with that. Now, this client also has 2 employer-provided health savings accounts. And so in retirement, what we want to do is we want to consolidate those health savings accounts, make it as easy as possible so that you want an individual HSA and you want to set that up so that it's not tied with your employer at all. One of the concerns that the client had is around IRMA paying additional fees for her Medicare Part B and Part D. Medicare Part B and Part D are going to be priced based on your income. And if you make above a certain threshold, then you're going to have to pay a higher premium. You can get that premium reviewed by filing an SSA 44. What this is going to do is it's going to allow you to request a review to adjust your monthly premium amount. In her case, though, we want to have 2 years worth of tax returns here before she submits that. So I'm giving her some direction on that, but that can definitely lower your monthly premiums and save you some money. Now, again, in her case, she's selling her home from Maryland to move to Pennsylvania. And as a result of that, she's going to have a gain of roughly $90,000. And in that transaction, she's not going to have any long-term capital gains here. So she's going to be below the $250,000 threshold that you're eligible to take if you're an individual. If you're married, you can exclude capital gains on a home sale up to $500,000. But in her case, she's single, so she's only going to be eligible to exclude up to $250,000 of capital gains. Because she's only expected to make about $90,000 on that transaction, then that full $90,000 should be tax exempt. according to this 121 exclusion. That's on the federal level. On the state level, in the state of Maryland, they are going to follow that federal standard, so there shouldn't be any taxes owed on that sale. However, because she will be a Pennsylvania resident when the transaction takes place, she may have to file this MW 506AE with the comptroller. This is for a non-resident who sells a home in Maryland, and it requires for the title company to withhold 8% of the sales price. So if you are in this situation, you need to file this MW 506AE with at least 21 days before the closing date. If you don't file that in time and it's not processed in time, then you will have 8% of the sales price withheld. So in her case, it's 370. She's expecting to sell the property for $370,000. So you're talking about, roughly $26,000 of money that's being withheld if she didn't file this form. And so by simply filing this MW 506AE with the Maryland comptroller, at least 21 days before the closing date, she could potentially avoid having roughly $26,000 withheld, and she wouldn't get that money back until she files her 2026 tax return, which means in 2027, that money would be held from her until her 2027 filing, right? So there's more information here if you want to take a look at that. It's just something that's interesting that you should be aware of. I know a lot of people are moving out of the state of Maryland into other states, and so you want to make sure that you understand the withholding there so that you're not surprised by that. Now, because she's moving into Pennsylvania, she's not going to owe any long-term capital gains because they're going to follow the same federal exclusion standard as Maryland does, so that $250,000 exemption or exclusion. So she won't have to worry about that, and she isn't a resident of the state of Pennsylvania when the transaction, she won't have filed a tax return in the state of Pennsylvania when that transaction took place. But obviously we want to refer to a specialist just so that they're getting guidance on that. As a financial planner, we know enough about these areas to help to bring some of the attention to the topic and give you some direction, but your CPA is going to know more about your specifics, and so they'll guide you on that. Now, as you transition into retirement, you're going to have to consider, how do you build an income? Most people are used to receiving a paycheck every 2 weeks, and when they go into retirement, they're no longer going to have that paycheck as from an employer. They have to go out and create a paycheck, often from multiple sources like your Social Security. You may have some retire pay, which she has in this case, or you may have to take distributions from your IRA. And in order to figure out how much you're going to need, you need to establish a budget. And you can create a budget automatically. Most people don't have a budget just at their disposal. And so what I suggested in this case was go and create a budget using Pocket Plan. This is a sample budget here, but effectively what happens is you sign into your bank account. It will create the budget for you. So it'll organize all of your expenses and all of your income. You can see, and then this is just sandbox data, so it's not like real, it's just dummy data, it's not real. But basically what it does is it creates the essential, non-essential, and savings categories so that you can see what your cash flow looks like and you know how much money you should plan for in retirement. So if she were to go through this and to create this, basically what she'd be able to do is to see what her expenses look like on a, let me see here, what her expenses look like on a monthly basis, and then say, okay, if I'm spending, this is just dummy data, this is not hers, but just for example, if she's spending roughly $7,000 a month and she has about, $3,800 a month coming in from her Social Security and her retire pay, then she just has to fill that gap, right? She would need roughly $3,200 a month from her IRAs. So what we want to do in retirement is we want to make sure that we have reserves. It can create a lot of anxiety for people if they are going from having a reliable paycheck deposited into their checking account every 2 weeks to now just living on their Social Security, on their retire pay, and having to make up the difference. And so if we create a buffer of roughly 6 months of expenses, what we're doing is we're giving peace of mind to the situation to say, okay, well, we don't have to worry about our standard of living for the next 6 months because I have all my expenses available in my checking and savings account. And this is how most people in retirement are going to have confidence and peace of mind that they are able to live their life without worrying about money. Because typically they're going to take distributions, say in January and in July, in order to make sure that they have enough money in their checking account in order to live life and enjoy it. In her situation, because she's selling her house, she's going to receive about $200,000 from the transaction. And that $200,000 is going to be split where she's going to pay off the mortgage of her new property in Pennsylvania, and then she's going to have $100,000 roughly available to use. But she's already sitting on some cash here where we can see that she is going to have more cash than she'll need based on based on her situation. So you can tell here she's got some cash already. So she doesn't really need $183,000 in cash, right? That's just more than what she's going to need to cover her expenses. And because the purchasing power of that cash is going to be eroded due to inflation, we want to make sure that it's invested and it's getting a return that hopefully outpaces inflation, right? We want to make sure that our cash is preserving the purchasing power. So we don't want too much cash in a checking account because it's going to lose purchasing power to inflation. And even at $100,000, if inflation's going up, let's say 7%, then you're talking about losing about $7,000 a year. That's pretty significant for somebody who's spending roughly $6,000 to $7,000 a month. So if she just leaves that $100,000 in her checking account, she could basically lose 1 month's worth of purchasing power, right? And from inflation. So a lot of subjectivity to that, and it's going to be dependent on your situation, how you spend your money, what you use to measure inflation, whatever. All I'm saying is that you should keep some money in cash, but not too much money in cash. Instead, you want to invest that excess cash in a brokerage account. In our case, one of the custodians we use is Schwab, and so we would put that money in Schwab, and then we would also invest it in something that is not going to have a ton of risk to it. It might be something like a money market fund or a comparable type of investment, but we would put that there. Now, this drives us into the next phase of this retirement plan, which is the investment plan. And in her situation, this is a 5-year cash flow from our financial planning software. And in her situation, she does have a few different retirement accounts with previous employers. And so what we want to do is roll that over into an IRA. So she already has an existing IRA, but what we want to do is roll over the 2 401k plans into her IRA at Schwab so that we're able to build the investment allocation that is based on her risk tolerance. We have access to a greater number of investments than what she would have in her employer plan. It's easier for us to transfer money whenever she needs it. And we can align the beneficiary information of that IRA with her estate plan, right? We want to make sure that we're taking into account the IRA as an asset, not just for today, but for the rest of her life. And so we want to consider what income needs will be on that IRA, what the beneficiary or the estate planning needs will be on that IRA. And so for that reason, we would, and others, we would consider rolling the 401ks over to her IRA. When you do a 401k transfer, if you haven't seen my video on this, then go check it out because I walk through how to transfer your 401k to an IRA. In that video, I talk about getting the physical checks and actually having to go and deposit those. If you have the option to do a direct transfer, that's the best way, where the custodian of your 401k transfers that money over to your IRA directly. That's optimal, but a lot of custodians don't do that. And so what ends up happening is you end up getting a physical check. And in some cases, that can take a few weeks. So I just requested that she set up some time with me to go through that. Finally, we get into the estate plan. And when you're moving states, when you're moving from Maryland to Pennsylvania, you're going to have to establish a new estate plan based on the Pennsylvania rules. If you are a resident of Pennsylvania, your Maryland will and your Maryland power of attorney and advanced medical directives need to be updated in order to be compliant with the Pennsylvania laws. So you want to work with an estate planner who's licensed in Pennsylvania. Oftentimes, people or firms that work in Maryland are dual licensed, so they can work with both states. But you need to establish that will, power of attorney, and advance medical directive. You should also, in her case, consider setting up a revocable living trust. She does have a daughter and she does have grandkids. Her daughter currently is living out of country. And so what we want to do is give her the certainty that if she passes, those assets that she accumulated would be managed according to her directions. And what this does is it creates the revocable living trust creates a separate entity that is going to manage those assets based on the client's directions. So we can specify how those assets are used, how much money is allocated at any given point. And it also can help with things like some divorce protection or ensuring that the money is used for her grandkids. So we want to make sure that the attorney is helping them with that. And this is where coordination with your financial planner can be very valuable because it can help with building that balance sheet. It can help you with giving you the title information so that you know which accounts are set up. And then once the trust is set up, what we want to do is we want to update that IRA beneficiary form with the custodian so that we're in alignment with the estate plan. We don't want your investments to be saying something different than what your estate plan has instructed. So that's a quick overview of the advice itself. There are a lot of moving pieces to this because it does involve different areas, and it can be overwhelming for many people because they're just transitioning into a completely new type of lifestyle where they're not receiving a paycheck. They're having to make decisions on all these different areas. I really encourage clients to schedule some time where they can take a trip that first year of retirement so that they have that milestone, that experience to say, wow, we did it. In her case, she had already planned out a couple of trips to Ireland and to the Galapagos with her friend. So that was pretty cool. But what you see here is a tool that we use. Again, this is the financial planning software. This is one report of many. But when I show this to clients, many of them have confidence and peace of mind that they're going to be able to navigate all of these decisions in retirement. And they know where their assets are. They know what their income could look like. And they just have a better sense of confidence because they can see not just what things look like today, but how they look going forward. So overall, these are really great assets for you. They often are going to be updated at least on a quarterly basis. And it's a good reference for when you have that conversation with your financial planner. So if you are considering retirement or you have some questions about retirement, you want to know, how do I navigate all these different decisions, all these terms like IRMA, if I have to file that 506, like what does this mean? That's where professionals can help you out. And they'll often do it in a way that makes you feel a little bit more comfortable so that you're not trying to navigate all this by yourself. If you have any questions, go ahead and leave them below this video. I'm happy to help you out. I'll leave my contact information if you want to get in touch with me directly. Thanks so much. Talk to you soon. Bye-bye.